This lecture will be on part 2 of chapter 11, and the topics to be covered are dividends and retained earnings. As this slide indicates, there are 4 different types of dividends. We're going to focus on cash dividends and stock dividends, and cash dividends is the most common method of distribution of earnings. And as you notice underneath, it says dividends are generally reported quarterly as a dollar amount per share, and with that, corresponds to cash. So, before the board of directors can make a formal declaration of dividends, they have to check out a few things. First, they have to make sure that there's adequate retained earnings out of which to pay dividends, because remember, dividends is a distribution of earnings. There must be adequate cash if it's going to be a cash dividend. They must also look at debt agreements to make sure that there are no restrictive covenants that limit the amount of dividends that could be paid, or whether or not dividends could be paid. The corporation is under no legal obligation to pay dividends unless they make a formal declaration. But of course, as I said, they have to make sure they have adequate retained earnings, they have to make sure they have cash, and then they also have to check out any restrictive covenants in the debt agreements of the corporation. This next slide gives us some important dates with respect to dividend payments. So once the board of directors have done their homework, determined that the corporation can pay dividends, they make a formal declaration. Of course, that's called the declaration date. And you'll see later on in some slides that the journal entry that would be made on that date would be to debit cash dividends and credit dividends payable for whatever the amount is. So that dividends payable is a liability. They now owe the shareholders that money. Because of all the activity on the secondary market of stock constantly changing hands, determination has to be made in terms of who is entitled to the dividend. So 3 weeks after the declaration, the corporation will designate the date of record. On that date of record, the shareholders that are holding the stock at that point will be paid the dividends. And 3 weeks after that, the dividend payment is made. And we'll see this in another slide, that when the dividend payment is made, there's a debit to dividends payable to wipe out the liability and a credit to cash. And this is an example. So on December 1st, the directors and media general declare a 50-cent per share cash dividend on 100,000 shares of $10 par value common stock. Information about the par value for our purposes here is irrelevant. The dividend is payable on January 20th to shareholders of record on December 22nd. So December 1st is the date of declaration, so we have the journal entry, a debit to cash dividends and a credit to dividends payable. On the date of record, there is no journal entry, but on the date of payment, we have a debit to dividends payable and a credit to cash of $50,000. Now, when it comes to preferred stock, the preferred shareholders have preference over the common shareholders in terms of dividend distribution. Also, for preferred stock, the dividend is stated as a percentage of par value or as a dollar amount. And whether it's a dollar amount or a percentage amount, that dividend rate does not change. Most corporations' preferred stock has what is known as a cumulative feature, which means that preferred shareholders must be paid not only the current year dividends, but any unpaid prior year dividends before the common shareholders can receive the current dividends. And the unpaid dividends from prior years are called dividends in arrears. So we have an example here. Scientific Leasing has 5,000 shares of 7% $100 par value. Cumulative preferred stock outstanding. Each $100 share pays a $7 dividend. The annual dividend is $35,000. So we have the 5,000 shares times $7 per share. If dividends are 2 years in arrears, preferred shareholders are entitled to receive the following dividends in the current year. So they'll get the annual dividend of $35,000. They'll get dividends in arrears, which will be 2 years, which is $70,000. So the total dividend payment would be $105,000. So the preferred shareholders must get $105,000 before the common shareholders can get the current year dividend. And this is just a reiteration of what I just said, that holders of cumulative preferred stock must be paid any unpaid prior year dividends and their current year dividends before common shareholders receive dividends. And I want to point out that is, for most part, they only get their current dividends. All right. So now, another example. On December 31st, 2017, IBR Inc. has 1,000 shares of 8% $100 par value cumulative preferred stock. So if we take the 8% and multiply by $100 on a per dollar amount per share, the preferred dividend would be $8 per share. It also has 50,000 shares of $10 par value common stock outstanding. At December 31st, 2017, the directors declare a $6,000 cash dividend. So there's a journal entry to record that dividend. Debiting cash dividends of $6,000, crediting dividends payable of $6,000. Of note, down below there's a calculation for annual preferred dividends, and it's $8,000. So they're $2,000 short in terms of satisfying the preferred shareholders. There is a cumulative feature. So then in the next accounting period, in order for the common shareholders to get anything, the preferred shareholders will have to get the $2,000 that's owed to them plus the current year dividend of $8,000. Right, and here's the illustration right here. So at December 31st, 2018, IBR declares a $50,000 cash dividend. And we have the allocation of the dividends between common and preferred. So in 2018, a total of $50,000 in dividends have been declared. So now we have to look and see what goes to preferred. First thing is the $2,000 in arrears from 2017, and then the $8,000 dividend that is due in 2018. So if we subtract the $10,000 of preferred dividends from the total dividends declared of $50,000, $40,000 will go to the common shareholders. At December 31st, 2018, IBR declares a $50,000 cash dividend. So the entry is a debit to cash dividends and a credit to dividends payable. So when the actual payment would be made, then there would be a debit to dividends payable and a credit to cash for $50,000. These next few slides entitled Do It, we have some more examples of problems related to dividend payment. So, Mastermind Corporation has 2,000 shares of 6% $100 par value preferred stock outstanding at December 31st, 2017. At December 31st, 2017, the company declared a $60,000 cash dividend. Determine the dividend paid to preferred stockholders and common stockholders under each of the following scenarios. The preferred stock is non-cumulative, and the company has not missed any dividends in previous years. So when we say it's non-cumulative, it means that if there were dividend payments missed in previous years, that the preferred shareholders are not going to get them. They're only going to get current year dividends. So we have the calculation for the annual dividends for the preferred shareholders. If you take the 2,000 preferred shares, multiplied by the dividend rate of 6%, and then by the par value of $100, preferred dividends would be $12,000. To determine what will go to common, we take the $12,000, subtract that from the full cash dividend of $60,000, and that gives us $48,000 in dividends going to the common shareholders. Here's another scenario. Mastermind has 2,000 shares of 6% $100 par value preferred stock outstanding at December 31st, 2017. At December 31st, 2017, the company declared a $60,000 cash dividend. Determine the dividend paid to preferred stockholders and common stockholders under each of the following scenarios. So this is scenario 2. So the fact pattern is the same except for the scenarios. In this scenario, the preferred stock is non-cumulative, so they don't get any prior year dividends, and the company did not pay a dividend in each of the previous 2 years. So the distribution won't be any different from the prior scenario. So the preferred shareholders are only entitled to the current year dividend of $12,000, so that the remainder of the $60,000 or $48,000 will go to common shareholders. Alright, we have the same fact pattern again. This time, scenario 3, the preferred stock is cumulative, and the company did not pay a dividend in each of the previous years. So, we've already seen that the annual preferred dividend is $12,000. Now, 3 years has to be paid. So the current plus the 2 missed years. So if we take the $60,000, which is the total cash dividend, subtract the $36,000, that'll go to preferred. What's left for the common shareholders is $24,000. Alright, so we've talked about cash dividends. Now we're going to look at stock dividends. And of course, as you might have figured out, stock dividend is a distribution in terms of shares of the company's stock. So why would a company do that? Well, first thing is they may not have enough cash to pay dividends. So instead of not paying out anything, what the corporation may do is instead go for a stock dividend where they would distribute additional shares to the stockholders without changing the proportional share of ownership in the corporation on the part of each stockholder. So essentially the stockholder is not going to have anything additional that they didn't have before. They'll have more shares, but the proportion of ownership does not change. Another reason that a corporation may issue stock dividends is to increase the marketability of the corporation's stock. So basically what this means is that the assumption is that if you put more shares in the market, based on the law of supply and demand, that would put downward pressure on the stock price, which would make it affordable for a larger pool of investors. And the third reason is to emphasize that a portion of stockholders' equity has been permanently reinvested in the business. So that what we're doing is we're taking funds from retained earnings and we are transferring them to paid-in capital. So stockholders' equity doesn't change. It's just the apportionment of the dollar amount. There are small and large stock dividends. We are only going to focus on the small stock dividend. Don't worry about the large dividend. So small stock dividend is less than 20 to 25% of the company's issued stock recorded at the fair market value. That's important. If you look down below, it says accounting based on the assumption that a small stock dividend will have little effect on the market price of the outstanding shares. So, how do we account for this? We have Medline Corporation declares a 10% stock dividend on 50,000 shares of $10 par value common stock. So obviously 10% of 50,000 is 5,000 shares. The current fair market value of the stock is $15 per share. So here's the entry to make the declaration. There's a debit to stock dividends. Once again, if we take the 50,000 shares multiplied by 10%, that gives us 5,000 shares. The market value is $15. We're valuing the dividend at the fair market value. So we're debiting stock dividends for $75,000. We will credit common stock dividends distributable for the par value. So we would take the $10 per share multiplied by the 5,000 shares involved in the stock dividend, and that gives us a credit to common stock dividends distributable of $50,000. The difference between the fair market value and the amount in the common stock dividends distributable account is the paid-in capital in excess of par common for $25,000. So that account, common stock dividends distributable, what that is saying is that the corporation has yet to provide those additional shares to the stockholders. So it's a liability. They owe them those shares. But until that distribution is made, the common stock dividends distributable account is on the balance sheet under paid-in capital, which you can see by the illustration. Now, if you look at this slide, down the bottom there's an entry to record the actual issuance of the dividend shares. So now we're going to take the $50,000 in common stock dividends distributable and we're going to transfer that into the common stock account because the 5,000 shares have been provided to the shareholders. So we're debiting common stock dividends distributable and crediting common stock. So this illustration shows us what the effect would be on the stockholders' equity section of the balance sheet and also on the number of outstanding shares and the outstanding shares if this dividend occurs. Alright, so if you look at common stock par value before the dividend, it's $500,000. Then as a result of the journal entry that we made, we increased the par value by $50,000. So now after the stock dividend, we have common stock of $550,000. Also, as a result of the dividend, we increased paid-in capital in excess of par by $25,000. So that total paid-in capital after the dividend is $575,000. That $75,000 comes out of retained earnings. So retained earnings before the dividend was $300,000, after it's $225,000. But one thing to notice is total stockholders' equity does not change. All we're doing is we're taking funds, we're transferring funds from retained earnings to paid-in capital. Right now we have stock splits. Now stock splits work best for investors in a bull market when stock prices are increasing. So with a stock split, first of all, there's no journal entry. The stock split is an issuance of additional shares to stockholders according to their percentage ownership. So that's the basic concept also carries over to the stock dividends. However, the stock split will cause a reduction in the par value or stated value per share. It'll increase the number of shares outstanding. It will reduce the market value of the shares. And there's no journal entry required. What is required is a disclosure or footnote that goes along with the financial statements that would disclose the stock split, what type of split it was, and the effect on the par value, and the number of shares authorized, issued, and outstanding. So, just a quick example, and there's another example in this presentation. Let's assume a 2-for-1 stock split, and the par value is $10. This is what would happen. A 2-for-1, the par value would decrease, would be cut in half. The number of shares outstanding would double. And then the market value of the shares would be cut in half. So years ago, when times were good, General Electric stock would run up in value quite quickly. What they would do is they would wait till the share price hit $100. They would let it sit there to make sure it's stabilized. What they would then do is they would declare a 2-for-1 stock split. So that price would be cut in half. And the reason they did that was to increase the marketability of GE stock. Alright, in this illustration, we have a 4-for-1 stock split. So before the split, there are 40 shares outstanding. So there are, if we can make believe this, 10 shareholders that each own 4 shareholders that each own 10 shares. After a 4-for-1 stock split, then those 40 shares grow into be 160 shares. So that each of those 4 shareholders now has 40 shares. They have 4 times the number of shares. The percentage of their ownership in the corporation does not change, and that each of those shares is worth less, and their par value has been divided by 4. So if the stock had a par value of $1 before the split, after the split, the par value is 25 cents per share. Alright, so here's another example. This one, there are 50,000 shares of common stock and a 2-to-1 split. The balance in the common stock account will not change of $500,000. Retained earnings will not change, so total stockholders' equity remains the same. What will happen though is that the number of shares outstanding will double. So we had 50,000, we do a 2-for-1 stock split, so that gives us 100,000 shares. Before the split, the par value per share is $10. Now, in calculating the par value after the stock split, we're taking the $800,000 and dividing by 100,000 shares, and we get a par value of $5 per share. So the number of outstanding shares doubled, and the par value was cut in half. So now we're going to switch gears and we're going to consider retained earnings. In the event that the retained earnings has a negative balance, that negative balance is called a deficit, and that deficit is subtracted in calculating total stockholders' equity. I had mentioned when we talked about declaration of dividends that there can be some restrictions on retained earnings. So there can be legal restrictions, there can be contractual restrictions, and one example of a contractual restriction was a debt agreement, a restrictive covenant on a debt agreement. And voluntary restrictions, what that means is that the corporation itself has restricted or set aside a portion of their retained earnings for a special purpose. That special purpose may be to expand the business or to buy a piece of equipment. Prior period adjustments. All right. The financial statements for a prior accounting period were prepared, distributed, and now we're into a new accounting period, and a discovery has been made that there was an error in previously issued financial statements. So the error could have been a mathematical mistake, a mistake in application of accounting principles, oversight, or misuse of facts. So instead of going back and redoing the financial statements, the way this is handled is through an adjustment made to the beginning balance of retained earnings. The next slide is going to be a T account, which shows you individual items that affect retained earnings. Retained earnings has a normal balance of a credit. So in order to increase retained earnings, we will credit the account. Then anything that decreases retained earnings will be considered a debit. So net income increases retained earnings, and prior period adjustments as a result of understatement of net income will increase retained earnings. On the debit side, things that will cause retained earnings to go down: a net loss, prior period adjustment because of overstatement of net income in a prior accounting period, cash dividends, and stock dividends. Also some disposals of treasury stock, but that we're not going to get into. And here is a statement of retained earnings. We've already prepared the statement of retained earnings, but now this is a little more sophisticated. So as we've always done, we start the statement with the beginning balance in retained earnings for the accounting period. We do have a prior period adjustment, and what it says here is that this is a correction for understatement of net income in a prior accounting period, and it was an inventory error. So that $50,000 gets added to the beginning retained earnings balance of $1,050,000. So the adjusted balance as of January 1st is $1.1 million. To that, we add net income. And that gives us a subtotal of $1,460,000. We then subtract dividends. We have cash dividends of $100,000, stock dividends of $200,000. So we'll subtract the dividends of $300,000 from the subtotal of $1,460,000, and we'll have an ending balance for retained earnings of $1,160,000 for the year ended December 31st, 2017. You will be expected to prepare the retained earnings statement as it appears in this slide. And the last slide for this lecture is the presentation of the stockholders' equity section of the balance sheet. And here we have it. All right. First of all, when you have preferred and common stock, the preferred stock is always listed first. And there are certain things that must be disclosed. It says 9% preferred stock, $100 par value, cumulative, callable at $120 per share, 10,000 shares authorized, 6,000 shares issued and outstanding. So that 9% is the dividend rate, and it's 9% of the par value. And once again, the par value is $100. So if we want to convert that to dollars per share, we'd take the 9%, multiply by $100. The dividend rate would be $9 per share. The preferred stock is cumulative, which means that any dividends and arrears must be paid along with the current year dividend before the common shareholders qualify for the current dividend. Callable at $120, that's what is known as the call price. So in most cases, preferred stock will have a call provision, and what that means is that the issuing corporation can go to the shareholders and buy the stock back, and the shareholders have to sell it back. But they know that up front before they invest in the stock, and they also know what the call price is, so they know what they're going to get before they even purchase the stock. So there are 10,000 shares authorized, so that's the maximum number of shares that they can issue, and they have 6,000 shares issued and outstanding. So that means that those 6,000 shares are owned by investors, and the preferred shares cannot be bought back and held in treasury for a subsequent reissuance. That only applies to common. Now for common stock, there's no par value. There's a stated value instead of $5. 500,000 shares authorized, so that's the maximum that they can issue. They have issued 400,000 shares. And it says there are 390,000 shares outstanding. So if you look at the difference between 400,000 shares and 390,000, that 390,000 represents shares that are owned by investors. The difference of $10,000 would be treasury shares, or 10,000 shares would be treasury shares. Those are shares, as we said before, that the corporation has bought back from investors with the idea that they will reissue them in the future. So far in this part of the statement, we have the par value for the preferred stock, the stated value for the common stock. The common stock dividends distributable, that would also be reflected at the $5 stated value. So the common stock's distributable of $50,000 goes in there as well. So we have a subtotal of total capital stock of $2,650,000. So that includes par value and stated value. The next part is the additional paid in capital. So that's the excess of issuance price over par or stated value. And we need to have separate accounts for preferred stock and for common stock. So we then need to subtotal the additional paid-in capital. We add that to the total capital stock, and that gives us a total paid-in capital of $3,730,000. From our statement of retained earnings, we get the ending retained earnings balance of $1,160,000. And there is a note. And the note states that retained earnings is restricted for the cost of the treasury stock of $80,000. If we take the total paid-in capital and add retained earnings, we get total paid-in capital and retained earnings of $4,890,000. We subtract the treasury stock cost of $80,000, so the total stockholders' equity will be $4,810,000. This also is something that you need to know, and is something that you will be expected to prepare on an exam or in a homework assignment. So that concludes everything that we need to cover in Chapter 11. Of course, there is a homework assignment, and there will also be a discussion board.